11%. That is how much Bitcoin mining power vanished last week. Not upgraded, not relocated, gone. Meanwhile, 6,000 miles away in Tokyo, the Nikkei printed its best trading week in 18 months. One market collapsing, another soaring. Same 7 days. This isn't coincidence. This is capital rotation. And when we traced where the money went, we found something unusual. The pattern looked less like a sell-off and more like a heist. Billions moving in coordinated waves, precise timing, institutional fingerprints everywhere. The getaway vehicle, the Japanese yen, the crime scene, Bitcoin mining operations across North America. And the motive? To understand that, you need to understand why Japan matters right now. Third largest economy on Earth. The yen funds half the leveraged trades on Wall Street through the carry trade. When Japan moves, global liquidity moves with it. Last week, Japan didn't just move, it roared. New prime minister, new mandate. 3 words that Wall Street understood immediately: growth and stability. And within hours, the capital rotation began. Institutional money started repositioning. Singapore desks, London funds, New York family offices, all rotating capital into Tokyo. The Nikkei surged, the yen strengthened, and Bitcoin left holding the bag. The evidence is in the charts. Nikkei up, Bitcoin down, mirror images. That is not correlation. That is capital leaving one room and walking into another. But there is something the charts don't show. Capital rotation alone doesn't explain the violence of the sell-off. If money just left crypto, the selling would taper. Prices would stabilize naturally. That is not what happened. Something else was forcing coins onto the market, something structural, and we found it in the mines. Mining difficulty dropped 11%. Let me put that in context. Difficulty only drops when miners shut down, not pause operations, not relocate equipment. Shut down. U.S. energy costs hit 18-month highs last week. Mining margins went negative for 70% of operations. The math broke. Weak miners faced a binary choice: bleed cash daily or pull the plug. Most chose survival. They pulled the plug. But here is what most people miss. When a miner shuts down, they don't just stop mining. They sell Bitcoin reserves, equipment liquidations, everything. Not panic, survival. Forced selling flooded the market exactly when retail was already running for exits. Which brings us to the pattern. This is where history gets interesting. March 2020, COVID crash. Miners capitulated. What followed? A bottom. Then a 400% rally within 12 months. November 2022. FTX collapse. Mining difficulty cratered. Miners capitulated again. Same pattern. Bottom. Then rally. This isn't opinion. This is data. Every single time miners capitulate en masse, it marks exhaustion. And exhaustion marks bottoms. Let me show you. The timeline doesn't lie. 2020 capitulation, bottom, rally. 2022 capitulation, bottom, rally. 2025 capitulation. And now, the question isn't if this bottoms. The question is, who is buying? Because retail doesn't buy bottoms. Retail doesn't buy fear. Retail is the fear. Institutions buy bottoms, quietly, systematically, right at the panic peak. So we asked, who is accumulating while everyone else is selling? The blockchain answered. We tracked large wallet movements during the sell-off. The blockchain doesn't lie. 3 names kept appearing, not selling, buying, quietly, methodically, right into the teeth of maximum fear. While panic dominated the headlines, these entities were deploying capital at scale. Different strategies, different assets, but one shared conviction. First, Binance. $300 million added to Sifu reserves. That is their emergency insurance fund, not accumulation for profit. Preparation. They are building a war chest for volatility. Second, Tom Lee, Fundstrat founder, Wall Street's most followed crypto analyst. 82 million deployed through Bitmine. Building an Ethereum treasury, not cautiously, aggressively. Third, MicroStrategy, the largest Bitcoin holder on Earth, added 1,142 Bitcoin, $90 million, at 78,000 per coin. 3 different strategies. One shared conviction. This isn't the bottom to fear, it is the bottom to buy, and MicroStrategy's position deserves a closer look. They now hold 714,644 Bitcoin. Let that number sink in. Average cost basis, $76,000. They aren't trading, they are accumulating. While retail runs for the exits, the largest corporate holder on Earth is adding to their position at these exact prices. Why? What do they see that retail doesn't? They see time. Here is what institutions understand that retail doesn't. Time. Minor capitulation is temporary. Energy costs fluctuate. Operations restart. Japan's rally? Temporary. Capital returns. But there is something else, something with an expiration date. The supply shock, and it is already in motion. When miners shut down, they stop producing Bitcoin. 11% of network hash rate offline means 11% less new supply hitting the market daily. Demand doesn't change. Supply contracts, basic arithmetic. The vacuum doesn't care about sentiment. It doesn't care about fear. It only cares about math. And the math just changed. Less supply, same demand. Price goes up, not eventually. Inevitably. That is not hopium. That is arithmetic. Institutions bought the setup. But there is one more piece. While retail watched price charts, things were moving in Washington. Illinois introduced a Bitcoin reserve bill. The CFTC opened discussions about stablecoin frameworks with major banks. Whether this leads anywhere remains to be seen. But the conversations are happening. At the institutional level, in real time, the infrastructure discussions are no longer theoretical. Now let us connect everything. The evidence. Clue 1. Capital fled to Japan. Temporary. Clue 2. Miners capitulated. Finite. Clue 3. Binance, Tom Lee, MicroStrategy, all accumulated during maximum fear. Clue 4. Washington conversations accelerating. 4 data points. 1 pattern. Not rotation out of crypto. Rotation within crypto. From retail hands to institutional balance sheets. This is the great rotation. Retail sees chaos, liquidations, fear. Institutions see structure, a supply shock in progress, temporary capital rotation unwinding, regulatory conversations advancing. The great rotation isn't the end of the cycle, it is the reset. Capital changing hands, weak sellers flushed, strong holders accumulating. This is how bottoms form, not with euphoria, with exhaustion. So here is the verdict. Japan's rally will fade, capital will return, mining operations will restart when energy costs normalize. But the Bitcoin that changed hands last week, it moved from fear to conviction, from leverage to balance sheets, from retail to institutions. You can trade the sentiment, or you can follow the structure. At Market Signals, we choose structure.